This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hello there, I'm Luann Fulmer. Welcome to the Rocket City Retirement Show with certified financial planner and financial advisor, my friend as well, Cris Wallace. He's president at WG Financial Group. So excited to have you here today because Cris is here to give you some really good advice about retirement planning. We have a lot to get into today. So if you do have questions that arise, here's how you can reach out to Cris and go in and see him complimentary. You may call or text the word visit to 256-937-2010. We have texting available. I know I like to text. It's very simple. Just text the word visit 256-937-2010 and get a complimentary discovery session. Remember to always keep in touch with WG Financial Group on Facebook. Anything that's going on throughout the week, just search for WG Financial Group 256. Our motto, plan, retire, and play. And you can find us online at wgfinancialgroup.com. Cris, hello to you. You are flying solo today.
I am. The birthday boy is off work this week. Or I should say today, not this week. We don't give the whole week off. He gets a day off. But he gets a day off. Yes,
do you guys give days off on your birthday?
We do.
Yeah.
Yeah, we do.
Oh, that's nice. I like that.
Yeah, we do several things that we try to, I guess, make it better for the team there, but we'll cater in lunch on Monday for the team, and we all try to eat together and have fun. And it's so fun to do that because, and we're not allowed to talk about work. So we're sitting around, we're having lunch, and just the stories that come up. And Graham is a riot. Like the stories he tells. I mean, he tells stuff on the radio.
We know.
Yeah, you should hear him in the office. So it's a lot of fun. And so a lot of the team members will just talk about family or funny things. And it's just, man, it's really, really funny. But as far as birthdays, yes, we give the birthdays off. And
I love it.
We try to make it fun to work at WG. That's what we want. We want our employees to be happy at work.
Of course.
We want the good culture, of course. And we want, we want that to bleed over into how we treat people.
Exactly. Yeah. Culture, says it all. So, okay. So we are going to get into the market. I was kind of disappointed. Of course, we're recording this on Tuesday. I was disappointed yesterday to see that the markets ended in, down again after being up last week. So
they were way down. Monday, yesterday.
So I guess it's because all the talk about Jerome Powell and Trump, of course, every president is mad when the guy won't lower the interest rates that they want him to, right?
Well, I only see Trump getting upset about that, actually, but I don't remember anybody else getting upset about it. But yeah, he was definitely talking about Jerome Powell.
Yes.
So he, made a nickname up and all that. So
I hate the name calling.
Yeah,
I don't like it, Cris.
I do too. I think there was a time it was kind of funny, but now every time there's somebody you don't like, there's a nickname.
No,
I don't know. I'm not really a fan of that. But
nope, me neither.
I'm kind of.
Hope he hears this.
I want my president to be a little bit more professional.
Presidential, right?
Presidential, yes.
Same.
Yes.
Yeah, I'm with you.
For sure. So yeah, Monday was rough. And then today, I'm looking at it right now as we're recording at 1:00, and looks like all the major indices are up right at 2% right now. So a little bit of a bounce back, and we're going to continue to have this volatility. And I'd sent an email to our internal client base, just kind of saying, hey, this is what I think is going on, and I'll kind of talk about it a little bit right here. I think Trump's got what's called his ego barometer, is the stock market. That's Trump's ego barometer. Huh. And the way that I look at what's going on right now is, I don't know if you did this. You probably didn't, Luann, but there's if you have a rubber band and the other person grabs it and you're pulling it apart, they're pulling it apart, and it's like, okay, which one of you is going to let go first?
Yeah, right. It's going to sting.
And somebody's going to get stung, right?
Yeah,
so that's kind of like the way I see what's happening right now. You've got President Xi on one side pulling one side of the rubber band, Trump's pulling the other side, and it's like, okay, which one's going to let go?
Yeah.
And really, what I told our client base is, I don't think it matters who lets go first, because the investor, I think, wins at that point. Because I think the market will bounce back. So if China comes to the table and they say, okay, we're ready to negotiate, and they come up with a deal, that's good for the markets. The markets will like that. Well, let's say that they don't come to the table and Trump buckles or pivots or whatever he wants to call it that day. And that would be good for the markets. So,
Yeah.
and we saw evidence of that. We saw evidence of that by the way the market bounced back when there was the 90-day pause.
Right, when he paused it. Yeah, a couple weeks ago. Yeah.
Yeah, and we actually saw evidence twice. We saw evidence when there was a rumor, and the market bounced up, and then it came back down. And then once there really was a pause, then, we did see that. So I think either way, the investor wins. And I think right now we just have to stay put. I think we have to remain confident in our plan, if you have one. If your plan is to get in and get out, good luck. I was talking with another CFP friend of mine out of Virginia he's really he's actually my best friend, and we were kind of communicating back and forth.
Uh-huh.
And I was asking him the other day, I said, hey, where do you think the support level's at? So in other words, kind of where's that bottom point for the S&P to see if it's going to break through and go a little bit lower? And his comment to me was, there is no support level for Trump's mouth. I was like, yeah. So, traders watch like signals, and it's real, even though traders watch the signals, it's still really hard to time that and get it right. And, his comment was, there was no support level for Trump's mouth. And I was like, you know what? You're right. Because all he's got to do is say something that the markets don't like, and it'll just drop a lot further.
It's so funny.
It is. One of the things that's happening right now, though, and I know there's a lot of people that have seen this, gold has really risen dramatically over the last month. Over the last month, but really over the last year to year and a half, gold has been on a tear. And I wanted to just talk a little bit about that. So we've talked about correlation of asset classes and non-correlation and things like that on the show before. But one of the indices to watch with gold is the dollar. So if the dollar is falling in value, you'll typically see gold rise. And we've seen really good evidence of that inverse correlation, is what we'd call it, over the past several months. But it's kind of been happening since, I think, around November of 2023. Gold has been taken off quite a bit. And over the last 1 year, I'm just looking at a chart. I use a software called Y charts to pull this. And over the last 1 year, gold is up about 41.6%, almost.
Wow, that's a lot, right?
Actually. Yeah, it's a lot. It's beating every indice out there right now. And then the dollar at the same time is down 7.37%. So, as the dollar is falling, gold is rising. And at some point, I don't know if we've got to see the dollar come back up a little bit, or we got to see gold snap back. It just looks like it's kind of running up uncontrollably at this point. And I think it's causing a little bit of euphoria. I've seen it even in my own internal client base, a lot of people asking about gold, how much should they allocate to it? And so I just kind of wanted to talk about that. So just one, be careful. Gold's a commodity, so it's just very volatile. There's a lot of, I guess, retirees and maybe people that are in retirement, senior citizens. They were on the gold standard at one time. And I think that they, I guess, feel a sense of security holding physical gold. So right. I have some people that want to buy physical gold and they want to have it, they want to touch it, they want to feel it. And I always laugh and make fun of them in a very, in a kind way. I say, what are you going to do with that?
What can you do with it?
It just feels good. It's like having a nice watch or something.
Yeah. The only thing you can do with it is sell it, right?
Well, yeah, because you're not going to go down to the local grocery store and, pull up. I've said it before. You walk in there with a bag of gold, you're going to look like a pirate. And people are going to laugh at you. Well, if you don't get robbed
what
first.
What century are you in? But, if you don't get robbed.
Yeah. So, right. But, when you own physical gold, there's a lot of things you have to be aware of. Number one, from a tax perspective, I actually think it's better to own something like gold in your IRA.
Yeah. When
you start, messing around with physical gold and you want to sell it, so let's just talk about the selling of it. So if you go to sell the ETF, it's a click of a button and it's gone within a few minutes.
Wow.
With physical gold, you have to find a buyer and you have to sell it. And there's like dealer markups, there's transaction fees, and there can be, other costs involved in owning and selling physical gold. So it's just a lot harder to unload. It takes a little bit more time. But then also from a tax perspective, this is what I was going to say a few minutes ago, gold is taxed at the collectible rate. So the collectible capital gains rate is 28%. So if you own that outside of an IRA, you may end up paying more taxes on it. So if your tax bracket is higher than 28%, you're going to pay 28% on gold. If your tax bracket is less than that, and you'll pay the lesser of that. But it's still taxed at a pretty hefty rate. So that's kind of my thoughts on gold. And
Okay.
and I'm just wondering at what point does it start to revert back a little bit, because it has run up a lot. I mean, a lot in the past few weeks. It's really, really gone up.
That's so crazy.
Yeah, if I look at it over the last 5 days, I'm just letting the chart refresh here while we do this. Yeah, over the last 5 days, it's up 5.64%.
Okay.
I mean, that's a lot.
Yeah, it is. In just 5 days.
1 month.
Yeah.
Yeah.
My
over the last
goodness.
1 month, it's up 12.41%. I'm just kind of flipping through these charts as I go. But the dollar is also down in the last 1 month, 5.61%. So we've seen a pretty good drop.
Down as much as gold is up. Huh.
Well, gold's up
I mean,
twice as much as what the dollar's down.
Yeah.
But yeah. So
Wow.
at some point, I just feel like we got to, I don't know, does it revert back? And I think you can get too far into it when it's already at its high point. I mean, it's the highest it's been. Really non-inflation adjusted. I think it's the highest it's ever been in history. And I was looking up the spot price earlier today just to kind of see where it was at. And looks like spot price for gold right now is at like $3,400 an ounce. So
wow.
it's going crazy. Like I said, and it gives people that euphoric feeling. So you have to stay calm. And one of the other things, just talking about the market right now, what I see is you have a lot of people that are very, I don't know, I think they're really anxious right now. If you voted for Trump, the feeling that I get from those individuals are, some are anxious, some are, I didn't vote for this. I didn't vote for this market to be this crazy.
Mm-hmm.
I thought the market was going to go up. And then you've got some people that are wanting to make very erratic moves right now. And I think right now is the worst time to make erratic moves. In other words, start making purchases based on feeling and emotion, because I'm telling you, the minute Trump opens his mouth and something good or bad comes out, he literally can move the market with his mouth in the short term.
Huh.
So the market right now is very emotional. So just staying true to your plan there, I think, is just, more and more key. But if this same thing, this is kind of the funny thing for me. In 2022, when the markets were down, remember we had inflation.
Yeah.
We also had a different president at that time.
Right.
So I would say that a lot of my clients were much more panicky at that point because of the sitting president. The market performance was down in 22. It was down a pretty good chunk in 25 as well. But the feeling is different with a lot of the people that I work with. They just tend to not be as worried. I'm like, well, my account's down a significant amount. I don't care who's in office right now. The market itself is down, but it just, the feeling and the attitude is just different in 25 than it was in 22, because a lot of our clients, they listen to our conservative radio station. So they pick our show up. Yeah. And so they tend to, lean right, of course. And they're just, the feeling is just different today. And it's
because
for
of
me,
the
it's just
president.
Yeah, just because of the president. But at the same, at the end of the day, your money's still dropping. So
right.
For me, I don't care if it's Ronald McDonald in office, man. The market's dropping. I don't like it. I don't
like it either. But don't do anything with it when it's dropping, right? You just let it ride.
Yeah, exactly. The conversation kind of goes something like this. Like I'm not really happy about the market right now, but I'm confident we're doing the right thing. I'm like, I sure hope so, because my IRA is getting punched in the mouth too. So anyway, so those are just kind of some market thoughts there. I think you really got to stay put, because this thing can turn on a moment's notice. I mean, on a moment's notice. And I think, and we've seen evidence of this, something could be said, something could be tweeted or posted on Truth Social, and boom, the market jumps up, 5 or 6% in one day. Yeah. So you just don't want to mess that up. And there's an article in here, Luann, in the show notes somewhere. I want to say that it was talking about staying invested, and I want to try to pull it up because I thought it was really, really good.
Investors shouldn't try to time the market, probably.
Yes. And it talked about how if you missed just over a 20-year period, if you missed so many days of the market, you would totally just obliterate your returns.
Yes.
It would destroy them over a long period of time. So I want to pull that article up. Do you know which article that was in?
Yeah. New report affirms old warning investors shouldn't try to time the market. It's the third one. And
yes. Okay, here it is.
Okay.
Yes, thank you for pointing that out. I knew it was in the show notes, and I wanted to reference that because this is why this is really good. So in 2023, Fidelity Investments showed that if you had 10,000 fully invested in the S&P between January 1, 1980 and December 31, 2022, it would have grown to 1.1 million by the end of that period.
Okay.
Now, that's with you staying invested. That is turning off the news, not looking at the news. But if you missed the index's 5 highest days of returns in those 43 years, 5 days, Lou Ann. 5 days, meaning you got out because you were nervous. This is why investing yourself sometimes can hurt you. So during this 43 years, I'm going to say that again. If you missed the 5 highest days, you would have trimmed your final amount by 38%. So instead of 1.1 million, you're looking at 671,000.
Oh my gosh.
Because you missed the 5 highest days.
Yes.
Missing the 10 highest days, you would have reduced your earning amount down to $483,000.
Yikes.
55% differential.
Wow.
Missing 10 days. Only 10 days. It don't sound like a lot, does it?
No. 10 days, no.
That's why when we talk about investing and building a plan, it's like stay invested.
Yes.
Especially right now, because you could see a swing of easily 5 or 6%.
Yeah.
So let me take it to missing the highest 50 days. You ready?
Oh yeah.
$76,000.
That's what you're left with?
That's it. Your 10,000 would have grown to 76,000 if you missed the 50 highest days.
And it could have been 1.1 million.
Could have been 1.1 million.
Oh my gosh.
Stay invested.
Right.
I played sports in school. I hated to sit the bench.
Yeah.
I don't want to sit the bench with my market money either. I've told it before on the show, Lou, and I do not manage my own personal assets because I also get emotional.
Yes.
I also want to stick my hand in the cookie jar. I need to stay invested. So I turn it over. I pay a fee. I have it managed, all that good stuff.
Yeah.
Just so I don't mess around with it. Now, does Chris have a little bit of play money? Yes, he does. And he always messes up. He did. That's the truth.
Yeah.
Because, I get emotional just like everybody else, and I want to buy and sell and get in and get out, and you just can't time this stuff. And there's all these little trader programs. I see it on Facebook. We didn't do a reel this week because Graham's not here, and it's not as fun without Graham to do real talk. But I see these advertisements because, obviously I'm a financial planner. And so you see all these advertisements to buy this software. It can tell you when to buy and when you need to sell. And I'm thinking to myself, if you were that good, Warren Buffett would be knocking on your door.
Exactly.
Like literally everybody would be knocking on your door. So that's a little bit of the market talk, Lou Ann. I really like that article you put in there.
Thanks.
That talked about the show notes. I did some other research too. I still think as you get ready to retire, if you're looking at retiring right now, especially the federal government is like a big place where a lot of people are getting ready to retire and have taken the delayed retirement option there, and the VERA is going around. So, that's stuff we do at the office all day. If you need us to look at that, to take a look at your retirement situation, we do understand federal benefits at the office, and we can assist you there. I know they have people come on site. That's great. They paid to be on site. I'm a part of a group in Nashville that gets on site to be able to talk to federal employees.
Good.
So we just use the radio as our advertisement for federal employees. We do understand it. And like I said, if you have somebody come on site, it's just somebody like me that knows somebody and was able to get behind the wall, is what I call it, the federal wall, and be able to come on site and talk to a group of employees. But like I said, we do it here too. So if you're a federal employee and want to have us look at your situation as you get ready to retire, we're happy to do that. I'm going to go ahead, Lou Ann, and give our number out, 256-937-2010. If you want to call for a consultation, a discovery session, we'd be happy to talk to you about that. 256-937-2010. Okay, let's get a little bit more into the show, Lou Ann. I know you've got some questions and stuff kind of prepared. Let's go ahead and start maybe just walking through some of that. some of those questions, and then we'll kind of end the first half of the show here in a few minutes because it looks like we're cranking down on time here.
Right, we are. So
left.
no more about the market, but we're going to just talk about some retirement unknowns.
Yeah, let's do that.
Yeah. Okay.
Just
cool.
some retirement unknowns.
Okay.
Let's kind of go into that subject.
So first of all, thank you for joining us today. So happy to have you along. I'm Lou Ann Fulmer here with Cris Wallace. So look back at your past 20 years. Okay, you think of all the things that happened to you that you did not see coming. Well, some of those were good things and some of them were maybe some big obstacles. Well, either way, there were unknowns in the past and we're going to continue having them in the future. And that's why we're going to talk about big unknowns in retirement. Give us some of those, Cris. What are they?
Yeah. So some of the big unknowns is, well, you don't know how long you're going to live.
Yeah, that's a biggie.
It's a huge unknown. I think just a few weeks ago, we were kind of talking about longevity and, I think Graham said something along the lines of, if we just knew when you were going to die, it would really make our job a lot easier.
You could really plan.
Oh, it'd be great. I mean, well, I say it would be great. It would not be great because you're going to sit there and dread, the day of death is coming up.
No, I can't. No, that'd be awful.
From our perspective, no, it would be great. Like if we knew when you were going to die, because then we could just point to the calendar and go, okay, all right, that's when God's calling you home. All right, we need to build a plan out here. We can spend every dime of your money and we're going to bounce the check on the last day that you're living. Yeah. The last check we write is going to bounce. We could literally time it like that.
That'd be great.
We don't know that. No. And I think that when we talk about longevity, that's just something that's unknown, and there are more and more people living longer. And I know that there's been a little bit of a downtick, probably thanks to COVID with longevity just dropping just a hair. Uh-huh. But the reality is, it's a lot longer than what people used to live. And the problem with living longer is that you're going to have higher healthcare costs, more than likely.
Right.
Because even though, if you think about your retirement, let's say you retire at 60. And the first 10 to 12, maybe 15 years of your retirement, you're going to be going pretty good. They call those kind of the go-go years where you're spending more money, you're doing more, you're able to travel, you're probably still in good enough health to do all that. And then you hit your middle 70s to around early 80s and things kind of slow down a little bit. And those are called the slow-go years. And then when you get into your middle 80s a little bit later, those are kind of the no-go years. You don't go as much. You don't feel like it. Your body's kind of worn down. And that's just what happens.
Yeah.
Our bodies just break down over time. They have a lifespan. And so with that, you will see that most people tend to spend less as they age. Those first few years, again, you're going to spend more because you're doing more. It's, hey, let's go get the bucket list items done.
Yes.
Let's travel. Let's do all this. But your expenses over your whole life expectancy are probably going to drop. Well, that's not going to be the case with healthcare. Because as your body breaks down, you'll require more healthcare. I was sitting next to a very successful young lady on an airplane coming home from Orlando last weekend, and she was talking about, HSA. We were talking about HSAs because that's what we think a lot of people should look at those. We don't sell them and we don't get paid for them. So I would say it's a great vehicle for older people as well, like myself. So I'm talking to her, and she had no idea what an HSA was.
Really?
And so I was just kind of talking to her about, hey, you're not going to the doctor today, which is a prime time for you to have a high deductible health plan and an HSA, and a great opportunity for you to put away some money and save on taxes and have it there in the future. Really thoroughly enjoyed kind of just talking with her because she had not seen one of the reels on an HSA.
Really?
She basically was talking about the funds that she purchased and how her dad helped her. I think her dad is a retiree from Boeing out of St. Louis.
Oh, wow.
Yeah. So he had done, she's doing some of the right things. So we had good conversation on the plane because I told her, if you put this money away for your health care, as you age, you're probably going to go to the doctor more. And as a retiree, that's exactly what's going to happen. I think your healthcare costs are going to go up. One, your healthcare plan is going to get more expensive just because healthcare dollars and costs are going up. You cost more to insure as you age, and then your health is going to decline. So we've got longevity, we've got healthcare cost, and then we got performance of the market over time. So that's an unknown. One of the things that I think we do have to think about when we retire. And I was thinking about a couple of a couple of people that we wrote annuities for last year. And the reason we did the annuity for them was they were kind of on the borderline of being able to make it all the way through retirement without running out of money based on the way that we do it in our simulators.
Yeah. Uh-huh.
So we just felt like it was a safe move for them to guarantee some additional income because of the potential of what is actually taking place right now. So I was thinking about it. I was like, man, I'm so glad we made that recommendation when we did, because, you just don't know what the markets are going to do. And so when we talk about performance of the market over time, you have to think about, what if I retire in a time frame that's like, say, 2000 through 2010, where the market was just basically flat, or 1999 to 2009, the market was basically flat during that time frame. Well, that's the first 10 years of your retirement. So essentially, that's going to be, in some cases, it might be half of someone's retirement. And I would say on a longer time horizon, it's going to be a third. Regardless of it, there's no return there. The market's basically flat. So you have to think about that when you retire. Where am I retiring? Am I retiring into a bull market? Is it a bear market? Is the market kind of near the top? You have to think about that. And you have to think, oh my goodness, what if I do retire in the first 10 years, there is no return or very low return? Okay, so that's another thing. So longevity, healthcare, performance of the market over time. And then we have our friends that at the IRS, and we talk about taxes.
Yep.
That's a big unknown. We know right now, at the end of 2025, we know that the tax code is going to reset and sunset, basically, and revert back to where the brackets were when Obama was in office, unless President Trump gets an extension done or some sort of a modification. They're going to sunset. But what we don't know is past President Trump's, time in office, his second time in office. I've heard a lot of people say, first term. No. It's his second term. He's done.
What?
He's done after this. Oh, he can pass a law.
I can't believe that.
No, he's not passing a law to keep himself in office.
No, he joked about it, but he can't do that.
Yeah, he can't do that. So anyway, we don't know what taxes are going to do past what they are today. If he gets an extension, that's great. Get an extension, keep the taxes lower. But we all know when the next party gets in there, it's going to be something like this. Oh, it's terrible. What they did was only for the rich and only for the wealthy, and it didn't help the middle class. And I'm going to change the tax code, and I'm going to make it this. So they can change the tax code or modify some things, and it does take Congress to do that. So that's one of the things I am concerned about with President Trump, is getting some sort of a modification or an extension. He can't do that with a pen. It's going to take congressional approval to get that done. But even still, even if he gets it done, like I said, we just don't know what that's going to be long term. So some big unknowns: longevity, healthcare costs, and performance of the markets over time, taxes in the future. Those are the big four that we just don't know about. And Luann, I tell you what we do know about. It is the end of the first half of the show. So if you're catching this on the way to church, you can hop out to Apple Podcasts or Spotify. Listen to the whole episode there. The whole episode will be there. And if you need to give us a call, want to set up a discovery session, you can do that by calling 256-937-2010, 256-937-2010.
Market difficulties can be unsettling, but your retirement plan doesn't have to be. Take control by calling Cris Wallace at 256-937-2010.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
If lingering doubts like, have I saved enough? Or will my retirement funds endure? Are on your mind, it's time to consult with Cris Wallace. Text VISIT to 256-937-2010. That's 256-937-2010 to book your appointment and get the answers you need.
And we thank you so much for joining us today. This is the Rocket City Retirement Show. I'm Lou Ann Fulmer here with Cris Wallace of WG Financial Group, where we give you a lot of good stuff to talk about. Today we're talking about 4 retirement unknowns. We're going to dive into each one of these points that Cris just brought up, the big unknowns for retirement: living a long time, healthcare costs, performance of the markets over time, and then taxes. And Cris, this is what he and his team do. They look at your plan for retirement, and then they make sure that you do have a plan, a written retirement plan. This is what he's offering you today. He wants to help you with the Rite Retirement process. You're going to hear more about that. Rite. Rite is an acronym for your retirement income and investments and tax strategies and estate planning. All of that part of the plan. And he and Graham Bauer and the team are here to guide you, and they would love to help you out. So we give you this number out because, heck, give them a call. It's going to be complimentary to go in and see them. 256-937-2010. Again, you may call or text the word VISIT. And remember our motto: plan your retirement, then retire, and then play, and have the best retirement that you can even dream of. All right, Cris, let's get into this then. All right.
So, Lou Ann, real quick, before we move on to the next topic or question that you have for me. 8 years on the radio. Yeah. That's a long time.
It is a long time. We're celebrating it.
Yeah, longest running independent financial radio show in the Huntsville
Isn't that
area.
pretty dang cool?
It is cool. Yeah,
thanks,
it is
everybody.
really cool.
Thanks for listening.
Yeah, exactly. Thanks, everybody, for sure. So we still get a lot of calls, and people will come in and say, yeah, we've been listening for 4 or 5 years. Long time. Yeah. Some people will say 10. I'm like, we haven't been on the air for 10. He's like, I don't know. It's just been a long
Feels
time.
like it.
Yeah, it feels like it. Yeah, exactly. What did we say last week? We had was it 3?
The number of our shows?
Yes. How many episodes was it?
Oh, well, we're at 380.
380.
380.
So Graham, we did the math at the end of the show. This is off air. We're talking off air, you, me, and Graham last week. We did the show, and it was like 7.2 years of radio shows. Now,
right.
You say, we've been on the air for 8. Well, we've had some reruns.
We've had some reruns, yeah.
I do like to go on vacation from time to time.
Thankfully, you get to go. Yes, we want that. Yeah.
Yeah. So good. I mean, it's been good to be on the air that
has.
long. Good reputation out there, and I appreciate all the listeners.
Yes, we
making
do.
That happen for us. So
we are here for you, our listeners, and that's why we make sure that you get Chris's phone number so you can call him. So, okay, so let's take the first point: big unknowns for retirement: longevity. We do not know how long we're going to live. How can we make sure that our income is going to last if we do end up living a long time? Talk about some of the tools we could use, Cris.
Well, first thing we need to think about is when we get ready to retire. That's the big question: is do I have enough? So when I'm going through my discovery process with somebody that comes in, that's one of the questions. That what is the concern that you have right now? What can we help you out with? And one of the responses might be, well, I don't know if I have enough, and I want to know that I have enough. And I think that's part of that answer back to me is I don't know if I have enough. You can almost feel that psychological element kicking in. It's like, okay, I'm getting ready to retire. Do I have enough? I don't know if I do, because I don't know when I'm going to die, and I don't want to spend it. So I see a lot of retirees that they go into retirement, but they're afraid to spend money.
Yep.
When they really can, but they didn't do enough investigation. They didn't do enough planning to really give themselves the confidence. So they basically say, okay, well, guess what? I don't have a job anymore. So I can't spend money because I don't have a job, and I'm not putting money into my savings. And it just feels really weird to pull money out of savings. So I'm just not going to spend anything. I'm just going to sit home and not do anything. And that's really the wrong way to look at retirement, because you've worked your entire life to get to this point in life, and then you're just going to sit on your money. And you might say, well, I want some of it to go to my kids. Okay, well, that's fine, but enjoy your money. I've had conversation after conversation with clients and prospects throughout the years. It's like, you got to go enjoy life. This is it. This is it. When you retire, it's the last phase. You just don't know when God's going to say, oh, your time's up. Let's come on home.
Right.
Right. So how do you know if you saved enough? Okay. So One of the first things you do is, I feel like the way we do it at the office is, number one, that time horizon. We're going to plan for a longer time horizon because there is enough data out there that says that people are living past 78, which is the average age of death for a newborn. So you have to remember that's for a newborn.
Right.
As
not
you
us.
age,
Yeah.
as you age, those mortality tables do shift. So we know people are living longer. So we like to run people to their early 90s. And people are going, I'm not going to live that long. Well, you'd be really surprised. At age 65, a married couple, one of you has about a 40% chance of making it to your 90th birthday. So it's a pretty good opportunity for one of you to live that long. 40% chance is a pretty good percentage.
Yeah.
So we got to look at the time horizon. We got to plan for that. Then the next thing we have to look at is, how much are we going to spend? Like, what's our spend going to look like? Are we going to decrease that over time? What are we going to use as an inflation factor? And do we need to do some additional travel in there? And what's our health care look like? What kind of cost are we looking at? Are we looking at an Advantage plan, which is a little cheaper on the front end, maybe a little bit more expensive on the back end? Do I get a supplement? How am I going to build that in there? What's my inflationary cost? So we've got to know what those costs are, because that's money that's going to be going out the door. So our spending, that's going out the door. Our healthcare, it's going out the door. Now, it has purpose. We're spending money. We're probably traveling. We're buying groceries, all that good stuff. And healthcare, we got to cover our bodies with healthcare, but it's still going out the door. So now you have to figure out, what do I have to generate to replace that?
Yeah.
What do I have to generate to cover that? And how do I do that on an inflation adjusted basis? And that's where, we kind of come into play, and we look at a couple different softwares. We use a couple different ones at the office. And I've had people come into the office before, and they'll tell me they'll use these online simulators. And I've seen very few of them that have, I guess, been what I would consider to be okay to use. I think these tools on some of these big custodial websites, I don't want to say any names, I feel like they are probably not as thorough as they could be. And then also, I feel like when somebody goes to these websites to do these, let's just say you're, Joe or John or Sally or something like that. They go to these websites and they just kind of punch in some numbers. When you're in an office with a planner, I'm asking questions that you really don't know to ask. So I'm going to ask them and pull those answers out of you. And a lot of times you'll probably think, oh, well, I didn't even think about that. Well, that's what's happening when they go to these custodial sites where they have these, retirement calculators. Oh, your plan looks good. You're 100% or whatever they say. So you have to figure all this stuff out. We use a couple different softwares that factors in all of that. You also have to look at the returns on the market. Are you using, a more conservative rate of return? What kind of standard deviation are you looking at? What kind of cost of living adjustments are you applying to the federal pension, which is about 2.3% on average per year? What are you doing for Social Security cost of living? All of that makes a difference in whether or not the plan is going to make it, and to be able to give you the confidence and literally the mental freedom to go spend money. And so you need to make sure that the data that you're putting in is correct, and the output of the data from whatever software, is good as well. So that's how we do it, Louie. And I know it's a long way to answer that question, but that's pretty much
good,
what we
though.
do.
Yeah. Okay, so that's looking at someone's income and saying, okay, here's where you are, here's what you've saved. Are there any specific tools you guys use, though, as far as making sure that money is going to last a lifetime? Did you want to get into any of that?
Yeah. There can be, and it really depends. So I'm looking at the strength of the plan before I start making additional recommendation.
Okay.
So I want to get all the data in. I want to just think of it like when you go to the doctor. Like, I just had a physical done, so all of my blood work's starting to pop in, on the app, and it's like, okay, well, this is intolerance. This is, great. This is a little bit out of tolerance. Well, think of it that way. When you come into the office and we sit down, we gather all this information and we run it through our softwares to kind of look at how you are today. Because I don't want to start making recommendations if I don't know how you are actually sitting today. Because there are people that come into the office and I go, you know what, you're actually pretty good. And I don't know that we can really bring a lot of value outside of a couple other little things over here. Let's talk about those. But the plan and what you have happening today looks pretty strong. That's what we want to do first and foremost is just take a look at the baseline. And if the baseline is really good, then we may just say, hey, we can probably work off a withdrawal rate and be okay. But let's just say that there's a big deficit. Let's say you've got $5,000 a month in expenses and you've only got $3,500 of guaranteed income. So you're about $1,500 a month short. If that $1,500 a month short is putting a lot of pressure on the plan, on the portfolio, meaning the withdrawal rate's higher, then let's just say your withdrawal rate's higher than 4% and it's going to maintain that higher than 4% and continue to grow, then we may come back and say, hey, listen, I know you don't like the A word, but hear me out. Putting some additional guaranteed income into your plan and getting your guaranteed income coverage higher will lessen the stress on the portfolio. So think about it for a second at using that number right that I just gave you, $5,000 in expenses, $3,500 in guaranteed income. You got a $1,500 shortfall. If we were to cover that shortfall with something guaranteed, i.e. an annuity, what would that do? Well, that would pay all your bills every month with guaranteed income. Basically shows up every month, goes in the bank account, and you can pay all the bills. What are you not doing? You're not pulling out of the portfolio at that point. You're literally letting that portfolio sit. We talked in the last opening segment about missing so many days out of the market. It impacts returns. If you start pulling money out, now you got sequence of returns to worry about in retirement. So in a case like that where the plan is under a lot of pressure, then we might recommend an annuity in that case. And not all my clients have annuities. They don't. We don't recommend them to everybody unless we feel like there's a need for that, especially on the income side. A lot of people in the Huntsville area actually have federal government pensions. They have military pensions or they're older employees with some of the defense companies here, and they have pensions that way as well. So in a lot of cases, you don't need it. But let's say you're somebody like in my shoes, where when I retire, I'm basically going to have Social Security if it's still there, in its entirety, and then also my savings. And so I don't have a pension. So I may, depending on what my spend number is and what my withdrawal rate is, I may try to improve that by, adding guaranteed income. So that's one of the ways you can do it. There's other ways too, Luann. There can be rental income. We all know that's not guaranteed. We can say dividends, but even that's not guaranteed because companies can stop paying dividends. So the solid way to do it is to put an annuity in place, just like a pension. You're basically just taking some of your money and turning it into a self-pension to guarantee yourself income.
Yeah.
Period. End of story. That's how it works.
End of story. It's a tool if you need it. Like you said, you don't do it for everybody.
No.
But I like talking about it because it is something that could fill that income gap. So
it can. People are nervous about it.
We shouldn't be afraid of it. Yeah.
Well, they're oversold. That's the problem.
Oh, yeah. Sure.
They're just oversold by a lot of people.
Yeah.
And I think you just have to work with a company that kind of knows when to make the recommendation and when not. You got some people, that's all the license that they have. They just have a license to where they can only sell insurance products. So that's the only way they get paid. So they're definitely going to recommend it. So I think we look at the numbers first. And if the numbers tell us that you should probably think about it, then we have the conversation.
Yes.
If it doesn't, we don't talk about it.
Okay. Very, very good. We're talking today about 4 retirement unknowns. And this first one is longevity. Will my money last as long as I live? As long as I need it to. Then the other big unknown for retirement you mentioned earlier in the show is healthcare costs. And we always mention this number that Fidelity tells us. They estimate that a couple retiring is going to spend over $315,000 after taxes on healthcare in retirement, Chris. So that's a big number. It does not include long-term care. How do you help your clients plan for that?
Well, we've talked about this on the show a couple of times, but I'm a big advocate for what's known as a Medicare supplement. Now, if you're military, you have TRICARE Prime that you have to sign up for at 65. If you're federal government, you can take your FEHB with you into retirement, and those two are good, good plans to have. Now, I do have a couple of military clients who they've opted out of TRICARE. They don't like it.
Oh, really?
Yeah, and then I've got some that are former military, went to work at the federal government. Now, these setups are really nice. If you're military and you serve the country to protect us all, for one, thank you. Secondly, you retire after 20 years, you have a pension. And then you go to work for the federal government, you retire there and you have a pension. Now you got 2 pensions.
2 pensions, yeah.
And it's great. But the other thing here too that they have, this unusual benefit, is that they have TRICARE option for being military. And then if you're a federal employee, then you also have federal health care as well.
Yeah.
So when you get to retirement and let's just say you like the military TRICARE better, then you can just suspend your federal Blue Cross Blue Shield.
Okay.
But you can always activate it later if you want. So you get to retirement, you're like, okay, I like TRICARE, it's working out great. I'm going to suspend Blue Cross Blue Shield, and I'm just going to hang on to it, not get rid of it, just suspend it. And then let's just say 5 years later, you decide, well, you know what, I don't like this TRICARE insurance anymore. It's not as good as it used to be. You can, during open enrollment or open season for federal government, you can go unsuspend and start using the federal Blue Cross Blue Shield again.
Oh, that's nice. Wow.
Yeah, so if you have both, it's a really unique option. I've run into families before where I've kind of made the recommendation. So they're getting towards retirement. They'll come in and talk to us, and they're within about 7 years or so. One of the things that you have to do with FEHB is you have to have it for 5 years and you have to retire with it. So if you're about 7 years out, and I just ran into this a few weeks ago, but not military. So the person wasn't military, but they're about 7 years out and they were on the wife's insurance with one of the bigger companies that is located here in Huntsville, private company. So what I told them was, hey, if you want to take FEHB into retirement with you, then I recommend during the next open season that you start switching over to your husband's FEHB plan, because he's within 7 years and we got to have this thing for 5 years. And then that's a great opportunity for you to be able to retire early, because you're going to have really good health insurance. You know what the rates are going to be, and you're not going to have to fool around with Obamacare and trying to find private health care, because if you can just switch over and carry the FEHB for the last few years of your working years, then you can retire with that and then you have health care. So understanding these options, this is all part of it, Lou, and I know it's kind of went down a little bit of a healthcare rabbit hole there, but
it's okay.
This is what we do at the office. We ask the questions, and some people may not have known to tell that family that they have that option, and why it's important that they probably go ahead and start making the switch from the wife's insurance over to the husband. So insurance is tricky. You need to understand what your options are. If you don't have either one of those, like I said, I'm in favor of a supplemental plan. It's what my parents have, and they cover a lot. Advantage plans have the copays, the deductibles. You've got doctors, network of doctors you have to go to. You also have to watch out-of-state issues. So if you're traveling out of state, does your plan cover? Again,
if something happens.
Mm-hmm, yeah, exactly. And so that's stuff we look at the office, and we make recommendations on that. Of course, that's part of our planning process. We take a look at all of that, including investments and Social Security and healthcare. We look at the whole nine, is what they would say.
Very good. We're talking about some of the big unknowns for retirement. So we've covered longevity and, of course, healthcare costs in retirement, Cris. The next one you mentioned, a big unknown, is just the performance of the markets over time. We can't predict it, right? It's impossible. And, you gave a great example earlier in the show of what could happen, in a 10-year time. So that's a huge unknown that we are all going to face. So how in the world do you build a plan for good markets, bad markets, just anything? How do you do it?
Well, I think you have to think about building something that is going to work in all types of markets. And the closest thing that I can think about is turbulence. Like, I cannot stand to be on an airplane when it is bouncing around.
Yeah.
Because, my brain is like, this plane's about to go down.
Yeah.
I'm not going to survive anyway, but
No.
I still worry about it. It's like, okay, well, gosh, I got 3 kids and I don't have any grandkids yet.
Yeah.
So I want to see my grandkids. Well, they're not going to make it. This plane is like bouncing around.
You just can't go there. You just can't go there.
Yeah. So I don't know if I told you the story before. I'll get off on a little bit of a tangent here. So I was on the way home from Dallas. This is back in my automotive days. I'd flown out to look at a quality issue that I was able to help solve while I was out there. And I was on the plane coming home. And this was like, at the time, it was like the worst turbulence I'd ever felt in my life. Lots of pockets of drops. And this little old sweet lady was sitting next to me, and she grabs her rosary and she's just praying. And I didn't interrupt her, but when she kind of looked up and looked around, I said, hey, can you throw one in there for me too?
Oh,
Because I'm a little nervous. So
that's
I
so
can't
cute.
stand. Yeah, I can't stand to be on a plane. And if you think about like how you feel on an airplane, if you're, worried about turbulence like I am, that's kind of how the market feels like right now.
Yeah.
Like, the 2025 has been a roller coaster, and I can't stand those either.
Right.
So you're on a roller coaster.
Yeah.
And what it does is it messes with your emotions. So in a situation where you're going into retirement, I think it's great to build out a plan that's going to be a little bit smoother of a ride. So you can picture the stock market kind of up and down, up and down. We've seen the lines and the charts. What you want to do is kind of smooth that out a little bit. And if you're able to do that, one, that's going to help you relax a little bit more. It's going to help you be able to keep your hands off of your investments. It's also going to allow you to go out and play, which is what we talk about, all the time. And that's what we do. So yeah, we can build those types of plans that kind of smooth that out. There are obviously questions that we have to ask. And, a lot of people, when they retire, they do not want to go into retirement with the same level of risk. They want to go into retirement with the same level of lifestyle, but not the same level of risk. And sometimes what I have seen in the numbers that I run is if you go into retirement with that same level of risk, I call it the equity tough guy, meaning I can take being all stocks, all equity. I can do it. I've done it all my life. Yeah, but your plan can't handle it. And that's what you have to be aware of is I know you can handle it, but the numbers are telling me we need to back off a little bit. And it's just something you have to, you have to look at, you have to build a plan around, and you can build it to where it's a little bit smoother in retirement. The vast majority of people that I work with would prefer that their plan doesn't see a tremendous amount of big downside drops. And just remember, returns are kind of like a pendulum. What swings up will swing down. So if you're getting big returns, you're going to have big losses. So if you don't want to have big losses, you're not going to have really big returns either, because you're going to kind of constrict yourself a little bit there. And on that note, let me just say this. There's all kind of active managers out there. Oh, we can miss the downside and get you the upside. It's like, no, come on. If you were that good, like I said earlier, Warren Buffett would be on your doorstep. Hey, can you manage all of my our money as well?
Right.
So ultimately, Luann, yes, we can build plans that kind of have less volatility, a little bit smoother of a ride. And ironically enough, or oddly enough, when we run a Monte Carlo, a lot of times the less volatile plan tends to do a little bit better.
Interesting.
Yeah,
Well,
'cause
that's good to know.
Yeah, you're not pulling money out when the market's down
Yeah.
or big down.
Right. So obviously having a plan is going to, like you're saying, help us avoid emotional decisions, when things get rocky with the economy and the stock market. That's going to kind of give you that security.
It does. Yeah, it does. I mean, it's the same way like when we used to have the map we always talk about, though, was the Rand McNally map.
Yeah.
It's the same thing now with our phones and our GPS.
Yeah, GPS. Yeah.
Yeah, I use my GPS all the time. My wife, she's a rock star. She can remember all that stuff. Like, go here, especially in the cities. Like, go here, take a right. I'm like, I'm lost. Get the GPS on.
Yeah.
So when I have that phone and I have the GPS running, I feel better. I'm not making an emotional decision. I'm not getting frustrated. Should I turn here? Should I turn right? It's the same thing. When you build a plan, you can just kind of say, okay, hey, I can relax a little bit. Plan says I work. It's been run through 1,000 different trials and outcomes, and I'm good. So you can kind of relax.
I love it. 256-937-2010. If you'd like to feel a little bit more calm about your plan, reach out to Cris and our team. Get this discovery session. 256-937-2010. Call or text the word visit 256-937-2010. And again, thank you so much for spending part of your day with us today. I'm Luann Fulmer. All right. So we're talking about the big unknowns for retirement, longevity. Okay. We got to make sure we have enough money to make it as long as we live. We have to be able to cover healthcare costs. And then we have to have a plan for the markets and their performance over time. The other thing you mentioned is taxes in the future. And we do not know what the tax policy is going to be when we're in retirement, but we could be in retirement for 20, 30 years, Cris. So how do we handle that?
Yeah. So taxes, I think are, obviously you can't control it.
Yeah.
You can't control what the codes are, like the brackets. Like you can't do anything about that. Those are the brackets. But what you can do is control how much money goes into each one of those brackets. And I think there's opportunity for families out there today where They're probably going to retire. They're probably going to drop down in tax bracket. And it could open up windows of opportunities to do Roth conversions. I think right now is a great time to be looking at Roth conversions just because the markets are off a little bit. And I think if you convert now and put it into, a Roth where it could rebound tax-free as the markets rebound, I think it's, a good move for a lot of people. So there's, that's one of the ways to control taxes in the future. Go ahead and eat the taxes, as I like to call it, in a lower bracket. But there's some other things we can look at doing too. If you're 70 and a half, you can look at the QCD option and give directly to a charity from your IRA. Or if you're below 60 or 70 and a half, you can look at gifting appreciated stock, or you may even consider a donor advised fund. And you could consider all of these in conjunction with Roth conversions. You can stack a lot of this stuff together as well. So I think even though you can't control the brackets, like I said, you can still control the amount of income to a certain degree. We know that, our core tax strategies at the office are Social Security. And why is Social Security one of your tax strategies, Chris? Well, only 85% of it is subject to tax. So that's important because it's 15% that's not going to be taxed at the federal level. And we know the state of Alabama, the state of Tennessee does not tax Social Security at all. So it's a very tax favorable asset. So we want to make sure we're making the right decision there. Another core tax strategy that we have is tax loss harvesting. And this is where you're going to purposefully sell a security at a loss to capture the loss so that it helps you out on your taxes from a long-term capital gains perspective. So taking that tax loss harvesting is a core tax strategy of ours. Roth conversions is another one, and I mentioned it a few minutes ago. It's like, okay, we can do a Roth conversion, but are there some other things that we could do from a charitable standpoint to kind of offset some of the taxes from the Roth conversions? That's, part of the strategy. And that kind of leads into kind of that last strategy that I talk about here is charitable giving. I kind of mentioned it a few minutes ago, the QCD, the gifting of appreciated assets, the donor advised fund. Do we need to look at a charitable remainder trust? There's lots of ways to do some charitable giving and then combine really those three that I mentioned outside of Social Security: tax loss harvesting, Roth converting, and charitable giving, doing some sort of a stacking effect with all of those to really maximize your tax brackets during certain years, especially on Roth conversion. So yeah, Luann, we don't know what it's going to be. We just got to be prepared, and opportunities. I would say take advantage of opportunities now as opposed to waiting and seeing, because I can't see the future, but I can say that probably taxes are going to go up. I think there's a reasonable chance in the future, maybe 4 years from now, but I would say that I would say taxes are going to go up. And I will say this before we end the show, Luann. I mean, we know at the end of 2025 what the law says. So we know they're going up at the end of 2025.
Exactly, yeah.
Unless something's done. I'm kind of making the assumption Trump will get something passed as far as an extension goes. But we know they're going up at the end of 2025. So I would say, take advantage while brackets are down and come up with a tax planning strategy. So, Luann, that's all we got. We're out of time.
That's it. All the time.
I'm looking at my
Chris.
clock. I can feel your eyes burning a hole in me. We got to wrap it up. So hope everybody has an awesome and blessed week. Give us a call for your discovery session, 256-937-2010. Again, the number's 256-937-2010. I hope everybody's enjoyed it. And remember, this week, as you're out and about, coming into contact with others, remember to serve every situation, every person, and every situation with a servant heart.
Neither AEWM nor advisors providing investment advisory services through AEWM recommend or facilitate the buying or selling of precious metals.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisor requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.